everybody, but we are glad that you are here for us for the second webinar in the Homeownership Disparity Data Series. My name is Christy Luzar, and I am the Executive Director at the IRMED Economic Development Association. So we are very glad to have you all here. I think a number of you joined us for the first webinar that we had in December of last year. So a few webinar logistics. Here's who is talking today. We have Lamont Davis with KLD Construction Management Services, myself, and Bethany Sanchez with the Metropolitan Milwaukee Fair Housing Council. And both of them are co-chairs of the Take Root Milwaukee Education Advocacy Group. So we are excited to be here. Some logistics for you all that'll help ease you since we are doing a webinar today. Put any questions in the chat and we'll answer as many as we can throughout. And yes, we will be sharing the recording and the slides. So to all those that have registered. So, and they will likely be posted on UEDA's or Take Root's website too in the future. So today's agenda, today we are going to present some more data. So if you joined us last time, you saw a lot of data from the Home Mortgage Disclosure Act, or HMDA, that really focused actually on what the market looks like here. So who lends, how many loans, who are they lending to? We did a little bit of where are they lending. And so today we're actually going to look a little bit at more the borrower side. So what does it look like when people are applying for loans, and what does this data tell us? And so there are 3 reports that we're going to showcase today related to that. And then we're going to do a little bit of the overview of the economic disparities. And then we're going to discuss it. So it's a big issue. There's lots of information. Let's unpack it. And then we're going to strategize a little bit. And this is where you can be really active, whether it's chat or Q&A, and afterwards is like, what can we do to increase the application origination numbers for people of color? Because the disparities are there. And what can we do in partnership with our lenders? And so Take Root Milwaukee has a great long history of doing that kind of work. And so we are really excited to have those conversations today. So who we are, this is a little bit about Take Root Milwaukee, which is a consortium of community-based organizations and counseling agencies, realtors, and lenders. And is a program of UEDA's. And then we have also been partnering with the Milwaukee Civic Response Team, their economic recovery group. There is a section of economic recovery that focuses on the stability of African-American Hispanic homeowners. And so Bethany and I and others involved in our Take Root and that group, like Maria Prioletta and Bill Kopka from Associated Bank and Irma Yepes-Klassen from Zilber, are really thinking about how we could use the Take Root Milwaukee infrastructure to sort of support that stability and what we can do given the resources that we have. And so now I'm going to have Lamont Davis come on and introduce himself. Lamont? Or no, sorry, Bethany. I forgot. I did it wrong. Lamont, you're not next. Bethany's next.
Hi, Bethany Sanchez. I've worked for 20 years now for the Metropolitan Milwaukee Fair Housing Council, and am a proud founding member of Take Root Milwaukee. And as Christy said, Lamont Davis and I are co-chairs of Take Root Milwaukee's Education and Advocacy Work Group. And I'm particularly excited today to hand off the introductions to Lamont, because I'd like to introduce him. We'll make a formal announcement at some point, but it's kind of rolling out in waves. The excitement and the really great news that I'd like to share. One of my roles is I'm a member of the board of directors of the Milwaukee Community Land Trust. And the Milwaukee Community Land Trust is about to have its first executive director. And in 10 days, Lamont Davis will be that executive director. So thank you to Lamont, and we're so excited.
Thank you, Bethany and Christy. It's an exciting thing to take on a new challenge. I think as Take Root, we've been looking at different ways to encourage home ownership. And one of the alternative forms of home ownership is a community land trust. And community land trust has an ability to take off the speculation that's going on in the market by acquiring a property and acquiring the land and making it affordable, And that ability is remarkable because that property can be affordable for future generations. And so Milwaukee is embarking on something that's monumental, that's going to create opportunities for people to stay in neighborhoods of opportunity. And it's exciting to be leading the community land trust. So thank you, welcome. And I hope all of you on the call would reach out and learn a little bit more about the land trust, because we plan to do some major things coming up in the next year. So I think we'll get started and talk about a little bit about some of the reasons why we're here. And one of the things is we want to collect this data. And according to 2020 data from CNBC, this is no shock, but Black applicants are rejected at a rate 80% higher than white applicants. That's pretty shocking. And I think it looks the same in Milwaukee. This is a national trend, but Milwaukee, we're at the bottom of most of those indicators. And so what we need to do is we need to understand why, what happens, why are we at the bottom? And one of the amazing tools that Bethany has access to is Humdo data. And Humdo data tells you so much. It can give you general level information, but it also gets into some of the disparities and starts to talk about, you know, which population is being most effective, and it can really get broken down into a lot of categories, but also the denial reasons. So we're able to track the top 3, top 10 reasons of why people are denied loans, or whether that be for refinance, originations, cash out. And so Bethany's going to get into some of this information. And so I'll hand it off to you, Bethany, to get started.
Thanks, Lamont. So the Home Mortgage Disclosure Act, we call it HMDA, which is kind of a weird acronym, but anyway, HMDA was enacted in 1975 by Congress. It's a federal law that requires all financial institutions, so it's not just banks, it's not just credit unions, but it's anyone that makes any financial institution that makes at least 100 home loans of any type. Well, actually closed-end home loans, not open-ended loans, but home closed-end loans. It requires them to provide a wide variety of data to the regulators, and then the regulators are to make that public on an annual basis. And it's a huge help for us in our work and in discovering, you know, what's going on, you know, whether the lenders are serving the housing needs of their communities. And then most public officials don't access it directly, but come to us at the Fair Housing Council and ask us for reports, which we're happy to provide at no cost. The reports that I do I don't charge for them at all. Shedding light on lending patterns that could be discriminatory. And it shows where there's gaps and where there's some successes. You know, we've been able to track individual lenders and show that year over year over year, they've been really doing better and better and better, particularly when we've held their feet to the fire and they get, you know, enlightened that this is something that they need to be doing. So since 2012, Take Root Milwaukee has compiled this annual analysis of the HMDA data, and Christy does a great job of taking the reports that I give her and then crunching it into a more digestible form for our seminars. This series helps us to deepen our understanding of the data related to access to credit and the racial disparities that we see in homeownership rates. And then it'll help us inform our response to what we're seeing there. Next slide.
Okay. First, I'm going to do a quick poll just to see how familiar everybody on this call is with HMDA data. We don't want to assume, when we looked at registrations, I knew that a lot of you, but as I'm seeing the results come in, it looks like that's changing too. So never assume, always provide the information. That will give us a sense of when we talk through this. And I did post in the chat, you'll see, we'll show images of what the reports look like, but as Bethany said, it's a lot of information. And so there's a lot of different ways you can unpack it and present it. And so that's sort of the work that we do. So I'm going to end it because it looks like we have most people, 72%. I think that's good enough. So we have lots of people who are very familiar, and then we have a group of people who are sort of or not familiar at all. So this will be a great learning experience. And then for those of you who are somewhat new to this, we are going to be having our next webinar in December, where we're going to do that annual lenders marketplace result analysis again. So that's a great way to get deep into the Humdo data from a different angle. So we're going to do some quick slides around the economic disparities in the city of Milwaukee and comparing it to the county. And these slides are actually the same ones we showed in December. So I'm going to go through them a little quickly. But we didn't update them mainly because the census data from 2020 just came out. So I'm hoping by December we should be able to grab these, but also I will note likely probably hasn't changed too much, sadly. So that's some of the things we're going to talk about. But you can see here, this shows the homeownership rates disaggregated by race. So overall for the city and the county, and then you can see that there is a significant gap for the race between Black homeowners and white homeowners. And so this is a trend that is something that we have well known in our community for a long time. And then there's a lot of really great efforts actually coming together in the last few years to really think about how we can address that. And so this, like, as I just said, this has been steady and then actually increased since the Great Recession. So not great news. You know, you can see this. This is from PolicyLink's National Equity Atlas, and it is through 2017. So a little older, but at the same time, it really gives you a sense of how this disparity has been with us for a long time. And in fact, the Great Recession had a huge impact on people of color in our communities and their ability to both retain and buy a home. So, you know, we have, if the gap was already something for us to be really concerned about, it is more so now. So
I would say, Christy, too, that that the gap is probably likely widening, if anything, as a result of COVID.
yes, exactly. So we hate to be the bearer of bad news, but we're the bearer of bad news today. Yeah. And then you also see the median household income disparities here. So it's also interesting to look at the county versus the city, and then the differences between by race. And there's a significant gap again between white households and Black, African-American, Hispanic, Latino households in the city. And there's a, you know, and then we also have this percentage of white, you know, that kind of gives you a sense of the gap and the impact that this has on the ability of families to really be stable, financially stable, and build wealth. Housing costs is another way to think about stability of families and where people are. And so we have the median monthly housing costs for owners and renters, and then the percent of homeowners that have a high monthly cost in the city and the county. And so this is really about families or households that spend more than 30% of their annual income on housing. The interesting thing when you think about a home ownership is the difference between monthly housing costs for owners and renters is actually not very large. It's, you know, close to $150 to $200 a month. And so there's a lot of renters out there that could potentially be homeowners. The gap isn't that much significant. And that speaks a little bit to the fact that Milwaukee, as insane as the market has been for the last year, is still a pretty affordable market for buying a home. And so the value, oh, sorry, what?
I'm just saying on average. So these
on average, yes, on average.
Are averages.
All of these are averages. We know there are differences as you get to the neighborhood. And then the other thing to think about is the values and then how that speaks to affordability. So, and a lot of this, by the way, information is taken from the City of Milwaukee's Housing Affordability Report. They have done this twice now, so it's a really great source. Oh, I just realized I never shared the results of the poll. Sorry, guys. I'll do it right now real quick. Now you all can see it. Okay. So the median assessed value for the city and the county, and what that is affordable to for an annual household income. And when I first read that affordability report a couple of years ago, I thought, wow, that's an interesting way to think about the median assessed value and what that might mean in terms of household income and who has the potential to buy a home. And so when you get to, and this is obviously like back of the envelope type calculations in the affordability report, but it does give you a different way of thinking about it. And so when we think about economic disparities and affordability, the things that stand out as considerations are how can we decrease these homeownership disparity gaps? So for Black households, the gap is 28.5 points. I mean, it's significant. And then for Hispanic Latino households, it's 18.7. Many of you might be familiar, this Community Development Alliance and the City of Milwaukee released the Milwaukee's Collective Affordable Housing Strategic Plan less than a month ago. And this is a priority. We know that these disparities are significant. They really affect our community in so many ways. And so let's make that a major priority. And so what does that look like? It looks like creating opportunities for 32,000 Black and Latino homeowners. It's a big number. But when you break it down, which I did do that when I was reading the report, I broke it down over years and thought about it. It's achievable, right? So there's a website link so you can look at the report. And then what would it take to close the income and affordability gap? And this is something that Bethany and Lamont and I talked about as we were preparing for this. And we did this last time too, but it is an interesting way to think about home ownership opportunities. So if the average home in the city is affordable to a household that their annual income is $37,000, for Black households, their annual household income is $28,612. And so there's a gap of 22% of even just being able to afford the median house in the city of Milwaukee, right? And for Latinos, the gap is 1%. And so what do we need to do to close not only that disparity gap around homeownership, but we're really talking about a household income gap. And so this is a conversation, I think, in housing circles that has gone for a long time. Is at the end of the day, we all need to be really strong advocates for increases in wages and family supporting jobs, because we know that will go so far to helping people not have a housing cost burden, because it's one of the largest expenses a household has. So I don't know, Bethany and Lamont, if you want to add anything before I move on, or if anybody has any questions, and feel free again to put questions, comments in the chat.
I would say just to acknowledge again that these income levels are averages, that there's a lot of people that make more than that and a lot of people that make less, and that the gap is not quite so neat and tidy as what's being presented here, but it's the neatest, most succinct way to really show what we're working with.
Lamont, I don't know.
Yeah, I would agree that that's the case, because in some of the CDA work I did, we were able to see that African Americans are kind of not prohibited, but not likely to live in more affluent neighborhoods, that they're likely to live in poorer neighborhoods next to their neighbors. So you may have a situation where an African-American family is making $100,000 a year, but living next door to someone who makes about $22,000 a year. So again, that speaks to the ability to move around, have job access. And some of that, not that we want people to leave Milwaukee, but some of that happens when families leave the city and maybe go regional and move into the county, and they find themselves with better opportunities to increase the income. But to your point, Christy, I would strongly encourage us to be a part of collaborations that's looking to increase the wages in the neighborhood, attract manufacturing, water sector jobs, construction jobs. There's all kinds of jobs that we need to be trying to bring into the city so that people have a better access to improve their standard of living.
And we can do that as individuals, but also through our organizations, including the banks. There's ways for the banks to support that kind of activity as well. And we really encourage them to do that.
So this is our way of sort of setting the stage. So this is the universe, the place we live, right? So what more are we going to learn, and what are we going to do about it? So our first report is called the Humdo Lenders Overview Report, or Lenders Humdo Overview. This is actually a great place to start when you're looking at Humdo data. And there's a little snip so you can see sort of what it looks like. This is something that Bethany's organization, they subscribe to Lending Patterns Database. And so she can pull these reports in so many different ways. I use this report for the other analysis we do really as a place to start. And you can see at the top, if you look, it's the 2020 year, it's all lenders. We're looking at the city of Milwaukee, and there are no filters on this report. So it's all the loans that were applied for in the city during that year. There are a lot of other categories. So we're going to look at a few just to kind of break it down for you. Action, occupancy, purpose, denial reasons, income, and race. And this is of the loans and borrowers. And there's geography, there's average loan amount. You can look at adjustable rate loans that have been made, the property types. It's a really great report. So you could go into this in so many different ways. So for loan action, so this is, somebody out of all the loan applications, what happened to them? And so we actually did 3 years of analysis. So you can see how many were originated, how many of the applications were denied, how many were rejected by the applicant. So they just decided not to go forward, withdrawn, incomplete, purchased, and then the pre-approvals that were denied or rejected. And really what this is telling us is that from 2019 to 2020, there was nearly a 30% increase in loan applications. And then the increase in applications from the year to 18 to 19 was 14.3%. So, I mean, that's just a reflection of what we know is a very active market. And then over close to 60% of these loans are originated. So, but I mean, you can also say 40 to 50%, 45 to 55% are not. And then the percentage of denials has actually decreased over the past 3 years. Maybe it's just because there's more people applying, that kind of a thing. But I don't know if you want to add anything before I move on.
Just to be clear, that originated means that the loan was made. It was originated to a borrower. It was, there was no loan previous to that on that, between that lender and anyone on that property. It was originated to this applicant who now is the borrower.
Right. And the interesting number too, and this is something actually our work group talked about a little bit, and we may delve into at some point in the future, but out of all of these, you have all the ones that were made, and the rest of these categories are sort of all the loans that didn't make it. But there's this category of purchased loans, and those are loans that are purchased by other lenders, if I'm remembering this right, Bethany?
I believe that it's actually the other way around. It's loans that were purchased by the lender that you're looking at.
Oh, yeah.
Yeah.
Yes. And so we talked about
other lenders.
Yeah. Like, so how many lenders out there are actually purchasing loans versus actually originating them? I think that is where our work group was going with that, if I remember.
Well, yeah, most of them do both. But it's a weird arcane aspect of the mortgage market that probably bears some more digging into.
Yes.
Yeah, one thing, observation looking at this data is the number of originations pretty stable, but the denials decreased. And that's something that we should monitor, because I wonder if that means more people who are not really ready for home ownership are being approved. And we saw that in the Great Recession, where more and more people were approved for loans, and then a few years later, they weren't sustainable. So this is an example of what Humdo data does for you. It gives you a chance to kind of look at things and then peer into it a little bit deeper. So we'll be monitoring that.
I would say that on the flip side of that, I do think that that's something to watch and see if we can get a better understanding of. But I think the flip side of that might be that more people who are applying for loans are better prepared and actually have a better understanding of what they're getting into. So they're being successful in getting their loans originated.
Right.
Certainly our hope. Yes, it is.
Yeah. That's the glass half full. All right. We have a question in Q&A, and we will get to that. We'll bring it up, Wendy, when we get there. So the occupancy, so this is how many of those loans that we just looked at were actually for what they call principal residence, second, or investment property. And principal residence is the filter for owner occupied. And as you can see, the majority, a huge amount of them are for owner occupancy. So all close to 90% in 2020 were for owner occupied apartments. And kind of interesting that the share of loans for investment properties has declined. You want to think about it?
Well, that's the share of loans. It doesn't mean that owner occupancy itself has declined, because we know it hasn't, but people are paying cash.
Yes, exactly. So, and we know the cash market is very active. So loan purpose. So out of the loans that were, or applications, how many were for purchase, how many were for improvement, refinance, cash out refi, and then other. And this is where it gets interesting. So from 2018 to 2020, the share of loans that are refinances or versus purchases has increased very significantly. And so when you think about just that huge jump in applications from 19 to 2020, like potentially it's just, the refinance market is also very active with low interest rates. But so purchase loans have also increased. So, you see the percentages there. And so Wendy had actually asked a question that of the loans that were originated, what percentage were first-time buyers versus second home purchase? And so this kind of gives you a glimpse, but we don't know if any of those all those purchase loans, which were actually, how many were first-time buyers? And Bethany, I don't know if there's a filter in that in those reports.
No, there's not the filters, it doesn't show who's first-time home buyer and who's not. It's actually not part of the data set that lenders have to report.
Yeah, but it does give you a sense of the question, rather is it a second home purchase? I mean, that's like kind of could be your principal second residence, but.
Oh,
again,
but that's different. Yeah.
And I just saw Bill put something in the chat about cash purchases. I mean, that's something that's not captured in the Humdo data, really. So, and is a huge impact in our market. Okay, denial reasons. So of the loan applications that were made and those that were denied, here are some of the reasons why. And so we highlighted in yellow the top reasons. You can see the percentages are all very low or fairly spread out. But remember, on average, 14 to 19% of loan applications are denied. And it's predominantly issues of credit, savings, and LTV or loan to value. I don't know, Bethany, if you want to, or Lamont, if you want to add anything on there.
Yeah, the collateral does refer to the value of the property, and if the loan that you're applying for doesn't support the value that's assigned by the appraiser, that loan's going to be denied, and it goes into the collateral denial bucket.
Yeah, and then I think the other thing to remember is that in the denial reasons, one application can be counted in several categories. So, the loan officer that, they're denying the loan, they can check like more than one of these and that.
Right, they check a principal box, and then if there's another reason, they check reason number 2.
Yeah. Okay. So then you can also look at applicant demographics by income. So the Humdo's overview sorts it by low, moderate, middle, upper, and then unknown. And so you can see the 3 years here from 2019 to 2020, the share of lower income applicants actually decreased, with the other categories sort of static. And then one of the things that we thought about looking at this with the slight increase in loans to middle or upper categories could also be tied to that significant increase in refinances that we saw. Upper income categories might have more likely to have a home already, maybe do have some equity that they could do the refinance. So, that's one way to think about it. Obviously, we don't know. We're really just, it's conjecture at this point, right? But, knowing what we know, this is what we can think about. And then we have the applicant demographics by race. And so you can see over the 3 years, the percentage of applicants along each category, and white applicants continue to make up about half of all loans. And when you look year to year and then within the categories, the share of applicants by race remains fairly static. Like the percentages aren't that much different. It's not like white applicants went from like 40% to 50% or something like that. But there have been some slight decreases for non-white applicants. And so I think from our viewpoint, that's a trend that's in the wrong direction, right? So we want to think about how we can increase that. We talked a little bit about multi-race. I think that's sort of the, it'll be interesting when the census data, you know, when you think about that new category and people being able to kind of identify differently than they have in the past, right? You know, it's kind of hard to tell. And then you have actually quite a significant number of the applications in unknown or NA. So people are either choosing not to mark that question or they're not filling it out. So.
Yeah, and they're able to do that because, you know, just because of the way that the rules from the FFIEC and the Consumer Financial Protection Bureau, if you're taking a loan application online and you don't ask specifically what someone's race is, which probably most lenders are loath to do because of discrimination potential, then you don't know. I think some of them guess and some of them just say NA. Not available.
Right. And then we did a quick demographics comparison. So of the lender's overview that show the applicant demographics, what is the city of Milwaukee census quick facts? I was hoping I could get the 2020, but I couldn't find, it wasn't available on that site. So, and I didn't have time to dig into that, but this is from the 2019. And you can see that the demographics of the city are not reflected in the demographics of access to credit. You know, so we highlighted those percentages to see. Bethany and Lamont, I don't know if you want anything to add. It's pretty straightforward.
Yeah.
It is what it is, as they say, at least for now.
For now, yeah, let's change that.
Right. All right, so Lamont, take it away. Our key takeaways from the lender's overview report.
Yeah, you know, loans have increased over the past 3 years and denials has decreased. That's always good when we're going in that direction. So I would just add that, you know, this is also an opportunity for banks to consider small loan products, especially with the limited income of African Americans and Latino households that, you know, maybe we can increase those loans by allowing for smaller dollar amount loans that predominantly would be in the Central City. Over half of the loans originated and made were for owner-occupied properties, really good for the city of Milwaukee. That goes further to stabilize our tax base at a time when we're losing people. We really want more owner-occupied units versus investor-owned units. Most of the increases in loans is due to significant refinance activity. Excellent. Christy, Bethany and I were talking about the refinance and how great it is to be able to have an extra $200 a month, right? And so with that, we're thinking that, you know, how can we help really propel the income forward with people? Because if you refinance and you save $200, you should be banking that money. So Bank On and other programs that help people save money, this would be a perfect time to start capturing those folks before they start to think they have extra money. Let's just roll it right over into a savings account, keep it for capital needs, or, you know, maybe maybe you do want to take that big trip to Disney World that you've never taken the family to, but that could be an opportunity. On average, about 14 to 19% of loans are denied. And we talked about it's credit, it's savings, not having the down payments to come up with, or at least with the collateral. That's an interesting issue because that speaks to your debt to loan value. And maybe you don't have enough income to actually buy that property. So that's a problem where we need to try to grow income for households. Yeah, very good numbers. We didn't see anything in the last 3 years that shocked us about there's a dramatic shift other than the home ownership rate going the other way. I think that's the biggest concern that we had. White applicants making up over half of the borrowers. That's in line with what the city demographics is. What we need to figure out is how can we get more African Americans and Latinos to make up that percentage of borrowers that they represent in the city. So if you're Black and you're in a city where 39% of Black people are living in that city, you should be somewhere around 39% of the loan applicants. So we got work to do there. I think overall, this is very good information. And I think we just have to really focus on what's moving in the other direction, which is lower home ownership rates, and really focus on doing that kind of work. So there is some work to be done for us. And I think, Bethany, you're going to pick up and talk a little bit more about some of these things.
Thanks, Lamont.
Okay, so we've got two maps. Take it away, Bethany.
So part of my subscription with Lending Patterns gives me the opportunity to create maps that show originations or denials or other factors, and show the information that come on the the static reports, the number reports, in a visual way like this. So this is probably no surprise to folks, but people in the census tracts that have the greatest percentage of minority residents received on average fewer loans than the ones in the other census tracts with 50 to 80% or even less than 50% minority. So this shows it in a dramatic way, and shows us that we've got our work cut out. So those were the home purchase loan, or the originated loans. These are the loans that were denied. Yeah, sorry. No, these are the denied loans. And it's much the same story here. In census tracts where greater than 80% of the population is minority, these numbers are, actually, these numbers are not as many people applying there, but the numbers, are showing, where those denials are taking place specifically. And there's a bigger population of minority residents in those census tracts, so it's a higher percentage of the population. So today we're going to look at 4 of the reports that show one that shows all loans. So all loans includes the home purchase loans, home improvement loans, refinance, and cash out refinance. So the first one will be the all loans, and they show information on the loans that were applied for within the city of Milwaukee. And the aggregate numbers, these are aggregate numbers for all lenders as a group. They're not, this particular set of reports does not show any specific lender, but it shows all Humdo reporting lenders as a group and their numbers as a group. Also available upon request to me for any geography within Wisconsin down to the census tract level. I can do these reports and other kinds of reports, including market share reports for any specific lender. I think Christy and Lamont maybe had some comments.
Yeah, it was kind of related to the map. I was just saying that, we need to have more loans being originated. I don't know if we're going to get to that data, but not as many loans are even being originated or applied for in the city. And thanks, we have to do better.
Yeah, absolutely.
I think that was something our working group talked about earlier this year. And I think after we do the annual HMDA analysis, which looks at loans and where they're made, we could do some geography-based assessments. And I think that might show us by neighborhoods or parts of the city. And I think that would be an interesting exercise, if you will.
No, I will say that one thing that we're not able to do is neatly look at a zip code or neatly look at aldermanic district. I do have census code numbers for the aldermanic districts, but some of those census tracts are in the adjacent district, and so it's not 100%, neatly focusing on that district, but census tracts are fairly small increments, and we can look at that for your neighborhood, the neighborhood that you serve, or the neighborhood that you want to move into, or any specific group of census tracts.
Amy made a comment in the chat, and Bethany, you may know this, her comment is, we know that the central city markers are active though, right? Does this suggest that there's a lot of cash purchase activity here?
Yeah, that's the short answer. Yeah.
More reasons for banks to do smaller loans, so people who live in those neighborhoods can purchase, where you have an out-of-state investor who has $50,000 cash to buy a home. Residents of that community should have access to loans where they can buy in that neighborhood.
So this is the disparity profile. And I should point out that we're only showing the lending disparities by race in this particular webinar. But the profile, when you run these reports, farther down on the page, it also shows it by gender and by age. So if that's something that you're interested in, keep that in mind and let me know, and I'll run some reports for you. So these numbers show for every race, the total number of applications, that's the total apps. And I don't know about you, but I need to move these little pictures of Christy and Lamont and me over so that it's not covering up part of my page. So total apps are the total applications. And then the number of originations, and remember that's the number of loans that were made, the number of denials, and the number of fallout equal the total number of applications. The purchase loans is in there just to show it, but the purchase loans does not figure into the total applications. Originations were significantly higher for white applicants than Black and Hispanic, and denials were significantly lower for the white applicants. It shows us that we've got a lot of work to do in getting people, getting our applicants or getting our renters and people to understand the benefits of home ownership and helping them to prepare for it so that we can up that number of applications and then hopefully up the number of originations as well, where people successfully apply and make it all the way through the process to origination. Fallout refers to the loans that fell out of the application process. So the applicant might have gotten frustrated with the process, or they simply decided to go with another lender, or maybe there was some kind of a life event that prevented them from following through with it, and they just didn't present all of the documentation that they needed for the origination to go through, and it fell out of the process. So that's what that's about. So this one, the previous slide showed for all loans. This slide shows the lending disparities for purchase loans, home purchase loans. So we can see similar numbers in terms of disparities, higher numbers of originations and higher percentage of originations for white borrowers than for any others. And a higher number of denials. On the flip side, higher number of denials, particularly for Black borrowers, and higher higher fallout on the part of Black borrowers. So there's some work to do with, if you get someone in the door and applying for a loan, work with them to make sure that that loan does not fall out of the process, that it can move on to actually having a full-on underwriting and hopefully going to origination. And then next, we're showing these loans are just the applications for refinance or a cash out refinance. And similar numbers are showing up here in terms of who's getting the loans, who's being denied, and all out is. Again, work to do. And then this finally is home improvement. These numbers represent the actions by race on all applications for home improvement loans. The denial rates for home improvement loans are higher than for purchase or for refinance loans on all applicants. And one thing, we don't know for sure, but we're kind of wondering if that has to do with loan to value issues. If people are applying for loans that they need and want to get without having a sense of the loan to value underwriting that any given lender is going to do, and how their home might appraise or not appraise out in terms of supporting that value, the value of that home improvement loan on top of whatever loans they already have on their own personal books. Lamont shouts out for more products for home improvement, absolutely, and to the city of Milwaukee and banks like Great Midwest who have home improvement products. I know Peermax has in the past as well.
Yeah, that's been a drum we've been beating at Take Root Milwaukee for many years. It's a hard nut to crack, though. That's my other favorite phrase these days.
Right. So the key takeaways, originations were significantly higher for white applicants than Black and Hispanic, and denials were significantly lower for those white applicants. It's definitely not changed, and it's still a big problem for Milwaukee. The fallout numbers, we really need to decrease the fallout and increase the number of originations. Think about lenders that do that really well are really involved with the borrower and making phone calls and making sure they get their paperwork in and making sure that they understand what's being asked of them. Many of them, of those lenders, support home buying counseling agencies, and well, maybe not many, but some of them do, not enough. We need to beef up our home buying counseling agency presence so that more borrowers go into the process really fully understanding and really, being prepared to give the documents that they need to document that they're credit worthy to the lender. And when we have that more informed applicant pool, we're going to have fewer fallouts and more originations. Denial rates for improvement loans are higher. Again, we think that might be loan to value issues, but other people might have other perspectives on that. So if you do, maybe put that in the chat. We're interested in
one thing
you think is driving it.
Bethany, working in a home improvement, often a lot of the improvement loans are desperate grabs. When people cannot apply for grants or other home improvement programs, then they try to tap into equity that they may or may not have in the home. But unfortunately, a lot of times, at least in the core of our city, those homes have degraded so far that it's a risky proposition to provide a loan. And if the person is behind, Often they are because they can't afford the repair. So you'll find that they're behind on utilities. They may be behind on some, or even collections. And it just gets to the point where it's like, you're on a sinking ship. I'm not going to help bail you out.
Yeah, I think that's really good points. Really good points. So going forward, we'd love to get folks' input on what other variations of this report we should consider. Like I said, we can do neighborhood geographies. We can do MSAs if you want to look at a bigger geography. Many of the lenders these days are using the MSA, the Metropolitan Statistical Area, which in the Milwaukee area includes the 4 counties of Milwaukee, Waukesha, Ozaukee, and Washington. They state that as their assessment area for CRA reasons. And CRA tends to drive, maybe not exclusively, but in many cases tends to drive the work that banks do to provide loans to low and moderate income people and people of color. So that could be a reason to look at MSAs. I mean, Take Root Milwaukee and most of us focus more narrowly on the city of Milwaukee, which is why all of our statistics today are showing the city. But if you'd like me to run other reports for other geographies and even the state of Wisconsin as a whole, if that's of interest, just let me know. And then again, it can get down as small as 1 census tract or 2 or a group of census tracts if you're interested in a specific neighborhood. So NCRC always does an analysis of the aggregate national Humdo data that comes out. And this quote here, my response to it, I was talking to Christy, was, well, that's kind of a duh. Racism and discrimination in the financial industry, as well as persistent economic inequality, contribute to Black and Latino borrowers being more than likely than white borrowers to be denied for a loan. It's stating the obvious, but now we have data that backs up that information. And we didn't always have access to as much Humdo data as we do. And as John Taylor, the NCRC's founding president and CEO, who recently retired, some of you might be interested to know that, he's actually formally retired, probably still really involved. In fact, I know he is, but data drives the movement. Without data, we have a really hard time of proving what's going on and what's not going on, and really working effectively to address it. So again, Black and brown borrowers are significantly less than their white counterparts to get a home loan of any type, and more likely to be denied or fall out of the loan process. And again, while this progress is being made, the data shows that the system was historically designed to shut out borrowers, and it's still working.
I'll just add, this idea around data drives the movement. I mean, data can be really wonky and hard to wade through, but when you do this kind of work, it really allows us to have more informed, but also like strategic conversations, particularly with the lenders in our marketplace about how can they help us address this. And you can't do that when you don't know what you don't know, right? I mean, that's the phrase. And so I think it allows people to like dig deeper and think about, well, what, and some of these things, like we've talked about in the chat and throughout this presentation, there are a lot of things in the market that impact, whether it's a lender's ability or an applicant's ability to do some of this, but at the same time, there are things we could be doing. And if we're aware of it, we can be doing them more intentionally, and we can be more strategic about how we work together. Lamont, did you want to add anything? Otherwise, we'll move on to denial reasons distribution, which is what Jess Snoth asked about.
No, I just in the chat, I just reiterated that Bethany can help with the data, just so you can make the case for support. So you may be working on grant opportunities, you may be working on various proposals, and say, I wish I had those demographic, and reach out, and we can see what we can get for you.
And I just saw Amy's question in the chat around information around how appraisers affect access to loans. That is a great question. And I feel like our working group can investigate that a little bit. And I know that's an issue that the Milwaukee United Housing Group had been looking at closely for some time. And so I would be interested to know that as well.
Yeah, the appraisal numbers and really any mention of appraisals does not show up in the Humdo data. It's a separate issue, but it definitely is something that we'll be talking about in following slides and for, I think, months to come now.
Yes. And that could be our next webinar. Okay. Denial reasons distribution. So this is the last report that we're going to showcase today. And here's a sample of it. I've been trying to include these SNPs so you can see, so that way you're not surprised when Bethany sends one to you when you request one. You're like, what is this? This doesn't look like the spreadsheet I saw in the PowerPoint. So Bethany, you want to take it away?
Sure. So earlier we talked about denial reason 1 and if there's more than one denial reason 2, 3, and 4. So this denial reason 1 is pulled out here, and then 2, 3, and 4, if there are a 2, 3, and 4, are shown below it. So debt to income ratio. So the applicant's overall debt as a percentage of their income, and what that ratio is, and debt to income is often one of the big ones, and it does show up here as the second largest one in general for minorities. Now, this particular denial reason distribution is denials for minority applicants only. So for minority applicants, 5.78% of them had the debt to income ratio as a primary reason. Employment history is a factor for many people, but in this case, pretty low compared to other reasons. Credit history is the biggest factor in general. And then collateral is somewhere between debt to income and credit history. The collateral means the value of your home that you're looking to finance. And so loan to value issue is another way to look at collateral. So here we go. Non-white applicants versus white applicants, the number of applications for non-white applicants. And again, this is City of Milwaukee, and it's for all loans and all lenders. The City of Milwaukee has more, we're a majority minority city. And so the fact that there were 17,000 applications from white applicants and only 8,800 from non-white is, as Jamal says, jaw-breaking. Yeah, jaw-dropping. Maybe even break your jaw as you drop it on the ground. And the number of denials was about the same. So that was, an interesting stat. The raw number of denials was about the same. The percentage of denials, because of the large number of white applicants, is much bigger. The percentage of denials is much bigger for non-white applicants. So this is denial reason 1, and we'll just look at this and break it out. Why are they being denied? So poor credit history and debt to income ratios are the most significant factors for both white and non-white applicants. And again, collateral is the third most significant factor. Insufficient cash, they weren't able to verify the information, the credit application was incomplete, mortgage insurance denied, all those other kinds of things can come into play in a loan denial. Okay.
Thanks, Jess. I will look into that. There's a couple of things as we're going through some of these slides where I'm like, should have highlighted that, or I'll do that. And I'm going to add into when we get down the comments around the cash market, because you'll see in a few slides, it's not like we didn't think about it, but we just didn't put it on there. So, but we will take a look and tidy these up before we send them out. It's hard though. This really speaks though to why this work is kind of hard, where you have to kind of look at the information and think about what is this really telling us. And so, oh, she's funny. Okay, yeah, nobody else knew that but me about us. So, but when you think about, we all know credit and debt to income, right? Like these are things that our housing counseling agencies, all of this who work in the state, this is like not anything new. But again, this just affirms, then what are we going to do about it? Like, what are we going to do to make sure that we can increase those number of originations, and how do we work with people on credit history? And we'll get to some of that. And there's some interesting things that are happening in that space. So, all right, so discussion. Bethany?
So even if we assume that there's no discrimination in the decision-making process, and I think that might be a big assumption, but even if we made that assumption, the causes of the racial differences can be traced back to differences in education, income, wealth that were the result of decades of overt redlining, discrimination, and segregation. The redlining and discrimination are not as overt as they used to be now that fair housing laws and fair lending laws have been enacted. But I have to say that even those laws were weak in the scheme of things, and the enforcement of the laws, even that we did have, the enforcement of the laws and regulations was weak and continues to be weaker than I think is prudent. The other thing that we need to understand is that it's really been hard to prove discrimination, that a borrower was being treated differently because of their race or their ethnicity. All of the factors that any given lender looks at when they're evaluating and underwriting any given loan file are different. The amount of time that they've been in the job, their income, their cash on hand, their resources, any kinds of debt that they might have, the condition of the property, all those factors are different for every single loan. And so sometimes, those loan denials, well, hopefully in most cases, but we don't know for sure, those loan denials were prudent, but we need to continue to work hard to prove discrimination. And that's something that we struggle with, and we welcome folks' participation in that process and ways to be able to prove it. If it's there, we need to prove it.
All right. Okay. Take it away, Lamont. We are at the recap of what have we learned so far today?
So, I think what we learned is that, we have a good market. It hasn't changed much under COVID. 2021 would be an interesting year. So we're looking forward to being able to do our second session in December, where we get to some of the annual numbers. Loan denials, those are the reasons that we expect people to be denied. They're craving credit, savings, collateral. Those are pretty typical, and I've stayed kind of the same. And that's our job. We want to make sure we're abreast of what's changing in the market so that we can always be proactive as an organization with Take Root. I would say the other things is that, Black and brown borrowers are less likely to get a home loan of any type, and that needs to be changed. Denial rates are happening. And so some of those things, when you see in the previous slides where white borrowers have increased, we see that Black and brown borrowing has not increased, and it's pretty much the same. So is there some opportunity for us to do a massive outreach plan to make sure that people are aware of the opportunities that are available to them as minorities? And I think the trend for non-white applicants and lower income applicant is moving totally in the wrong direction. When you look at that graph that showed the home ownership rates, even through the Great Recession, gains were about the same. There was a big noticeable gap, but there was the same gains that was happening. And then after the Great Recession, you saw people of color ownership rates go the opposite way. And one of the things the CDA found out is that a lot of the owner-occupied homes that were lost to foreclosure did not return as owner-occupied in a central city. They returned as investment-owned. And so again, we have a situation that since 2005, originally 5% of the investor-owned properties were owned by out-of-state investors. We're up to 15% of that number right now. So a lot of fights that we need to have, and some of that is around this owner investment phenomenon that we're having in Milwaukee. And it's not just Milwaukee, it's a national trend.
Yeah, I'll just add to that, that is something that within Take Root Milwaukee, we talked about a lot. The city was well aware of and very concerned about how many of those properties were returning to ownership. But it's a case of too, like with the discussion around cash buyers, where you sort of, it's not like you're powerless per se, but there are things that happen outside of what you can control. So that's the part that makes this the most difficult, is you see those percentages or those numbers going the way you want, but that's why there's a lot of focus on an acquisition fund now. Like, can we start getting these properties so we can at least hold them and make sure that they get into ownership? But to Lamont's point, like Take Root Milwaukee, there's a Take Root South Florida, and we've started, Freddie Mac has helped facilitate. So we talk with and check in with them every month. And this is the same thing they're experiencing too. Like, and we've heard this as well at a national, like a lot of communities are experiencing this influx of out of state, out of the region, whatever, cash investor buyers. And it's very, frankly, it's the one thing that I worry about from like an existential perspective in this work around house, because it feels like one of those things unless I win the lottery and I create my own acquisition fund, that's like the only thing I feel like I can do at this point. But that's your glass half empty perspective. So
I will say that throughout the collective action and the numerous polls that the CDA, shout out to Cordella if she's still on the call, that Cordella conducted, acquisition fund rose to the top. And so there will be a lot of collective action around creating acquisition funds, not just for home ownership, but also to preserve a lot of renter units that are expiring. We've invested in a lot of live tech development for multifamilies, and those projects are coming to the end of their life, a lot of them across the country by 2030. And so we really need to be prepared to have an acquisition fund to keep those from speculative hands and get those back into nonprofits who work around affordable housing, as well as responsible landlords. And so the acquisition fund is priority number one. And the Community Development Alliances is definitely going to be looking out for people who want to be a part of the implementation teams to get that part moving next year.
Oh, that's great. Amy just shared too that the National Neighborhood Indicators Partnership. I mean, this is something, we are not unique, which is actually very disturbing to think about, because like you think about what will these neighborhoods look like? Who will own these houses and these multifamily units? And what does that mean for families in our community? So So that gets us to the last part of the webinar today, which is the now what? Now what do we do? I want to say these, as much as these are a lot of work per se, I'm sort of nerdy on the data side. I kind of enjoy this piece of the work that we do, but it's a great example of how you can get into the minutia, which seems like you could get lost in it, but at the same time, it kind of gets you down to the almost individual level of like, what can we do to sort of change these larger numbers and percentages? Because it does kind of get to the point of working at an individual level. Every mortgage loan officer that we have out there, every homebuyer counselor, every neighborhood organization and organizer, each of us has a role to play. And then we've had this great discussion about the outside forces, the larger community, the market, right? Those are all things that we're also operating under too. So Bethany, I think you were going to lead this part. So
Sure. So CRA, banks covered by CRA, lenders covered by CRA are banks. The depository institutions are required to do lending and investments and provide services in all of the low and moderate income neighborhoods that are within their assessment areas. And so that really gets a lot of banks to focus on those low income areas and thus in many cases people of color. There's still work to be done there as well, but we also need all lenders to make sure that they're doing everything possible to get potential borrowers in the door and then through the loan application process and then to the closing table. So there's a lot that can be done. So just to reiterate, we are going to be providing these slides and we are going to be providing a recording of this session after this is done. And along with those tools, we will provide a sheet that includes these suggestions for what we can do to increase loans to non-white borrowers and first-time home buyers and first-generation home buyers. There's a more extensive list, and I'll mention some of the things, but you can see the kind of the short list here, but it's really hard to pick among them because there's so many different things that can have an effect. Really, the home and small business lending and community development loans and investments are all interconnected, and one helps the other. And so it's important to think about the larger landscape, but some of the ones that I highlighted just to lift up today from the list that we'll send out, the resource that we'll send out, is partnering with and supporting the work of nonprofit housing counseling organizations that help the borrowers understand the home buyer process, get them into a sustainable home ownership position, and counsel them when they run into obstacles that threaten their continued home ownership. That's a huge thing that we need to support, a huge industry that we need to, or it's not a huge industry, huge in importance, small industry, and needs to become much bigger from our perspective to really do a good job of advocating for of helping borrowers to, again, get in the door, get to closing, meet their needs along the way, and make sure that they're staying in that sustainable home ownership position. Also, maybe even before people go to the home buying counseling agencies, although they do some of this work, it's important to partner with and support the work of financial education and credit counseling agencies who can identify potential customers for that loan pipeline and hand them off to the HRIs of the world. Most of you know what HRI is, but just to spell it out, it's Housing Resources Incorporated. They're not the only one in Milwaukee, but they're one of the bigger ones and an entity that really focuses on home ownership. UCC, the United Community Center, has a major home buying counseling function. and we're grateful for that. Axe Housing and other groups do it on a more sort of ad hoc, informal kind of way, but really helps for people to fully understand what they're getting into. We need to leverage taxpayer dollars that fund the NIDs, the neighborhood improvement districts, by contributing annual funds for home rehabilitation grants to extremely low income homeowners. Support green building development and energy retrofits. Those can help our home buyers and homeowners to reduce the energy costs that they have and help them to be more successful in their home ownership experience. Create a home purchase loan product to finance very small dollar home loans. Lamont has mentioned that several times, and I think it bears, it's worth repeating. Lead with innovative mechanisms to address loan to value issues on modestly priced homes and also on commercial properties that need repairs to bring them up to code. Another thing that we'll bring up on the next slide, but I'll just sort of tee it off now, is using alternative credit scoring models that use criteria that allows more people to be scored and therefore more people to be evaluated as a potential homeowner. Vantage Score is an example of that kind of alternative method. And partnering with our neighborhood organizations, introduce the loan officers and other staff to the grassroots organizations in the communities that you're looking to serve, and the churches and other community kinds of groups where other potential buyers can be identified. And the goal of all this is to ensure that all credit-worthy borrowers have equal access to fairly priced credit. And we really want to narrow and to the extent possible, eliminate the gap between the percentage of loans that are issued to minority populations and low and moderate income borrowers in low and moderate income census tracts, females, and the gap between those populations and the percentages of these populations that show up in our community. So I think that's probably,
before we go to the next slide, Bill Kafka made an interesting comment that, although we are focusing on CRA, and he agrees, but most mortgages are not originated by CRA regulated banks. Example, credit unions, Rocket Mortgage, Fairway, et cetera. So our focus has to go far beyond banks. Bill, if you had some elaboration that you wanted to do on that point, could you maybe chime in? Yeah. Or do we have to unmute him, Christy?
I would have to, hold on. I think the other thing I'll just add with that is the, here, let me see if I can find him. This is something Take Root has actually been thinking about for a while too. What can we do to sort of engage credit unions? When we do that annual Humdo analysis, we see these other groups, and that way we can sort of think about can we get them to be involved in this work with us and that sort of a thing. So that's definitely a target for us. I was going to add that, but I don't know, Bill, if you did want to chime in. I muted you.
Yeah, so I don't know if can you guys hear me? Just a confirmation?
Yes.
Okay, thanks. So clearly the banks need CRA as the motivator. We've got lots and lots of other lenders that aren't motivated by CRA. So there aren't teeth to make those lenders focus on what we need to. I mentioned credit unions, but the truth of the matter is credit unions actually, I think, originate more loans in our low and moderate income communities than the banks do. So they're not really the problem. I don't mean to imply that with my note. But many of our larger institutional lenders, those that are listening on the call and thinking about who are the players that can help move the needle from a lending perspective, it is banks for sure, but it's also those giant mortgage companies you see commercials for, and that get like if somebody goes to like lendingtree.com, they get referred to both banks and mortgage lenders, and we have to do quite a bit. We don't have the same tools to make those lenders participate in the market that we do for the banks. And I think on work groups that really come out of Take Root. I think we can focus a lot on that. Some of them are not the problem, but some of them could really help and lift a lot of the weight. And to be clear, another nuance to CRA qualifying loans is non-bank originators like Rocket Mortgage or Fairway, or some of the other big non-banks. Sometimes they create loans that banks buy for CRA purposes, and then that moves those banks to being qualified for CRA. What we want to make sure is happening is that net, we're creating more lending in these communities and not just moving those loans around from non-lenders, non-banks to lenders to make them qualified. We want to create more mortgage lending. So I'll stop with that. I don't mean to take over or anything, but I'm just thinking in the back of my head about what we can do as a group, not me just as a banker, but what we can do as a group to sort of get our non-bank lenders to participate with us. And I think they care. And I think Fannie and Freddie, who buy their loans, cares and will drive them to support and nurture plans that groups like Take Root Milwaukee create.
Right. That's
I agree with everything you've said, Bill. The percentage of non-bank home mortgage lending has gone up in recent years fairly dramatically. Those non-bank lenders are still subject to fair lending laws, though. So if there is discrimination that's taking place, please, if you feel that you or someone that you're working with or someone that you know has experienced discrimination in the lending market, please ask them to call the Fair Housing Council, and we can work with them again at no cost. The other thing is, well, two other things. NCRC, the National Community Reinvestment Coalition, which we referred to earlier, has long been advocating that in any kind of CRA reform that happens, that non-bank mortgage companies ought to, and credit unions ought to be covered by the Community Reinvestment Act. That will help to put another lens on what they're doing and another set of eyes, and give them some impetus for doing the right thing and helping ensure that all creditworthy borrowers have equal access to fairly priced credit. And then finally, NCRC does have a mortgage finance and community council that is that's made up of non-bankers from around the country, as well as our NCRC board members. And I chair that group. And so we do work with, the Rocket Mortgages of the world and actually title insurance companies and some other lenders are part of that mortgage finance council. So there is some work being done on that at the national level. And if folks from here can add their voices at the appropriate time, or at any point really, but especially when there are proposals being put out there, that would be really helpful and important.
Yeah, I'll just add to the things that we have on the slide are a few things we chose to highlight, and Bethany sort of shared some of the other things on the handout, which is really extensive, and we'll be sending that out. But this push-pull of we have a lot of banks that have local presence. And so a lot of the things that we highlight here as best practices come down to the people that you interact with and that work at these banks. And so when you think about, we all know, one of our slides originally said everything that this person does, because we all know loan officers and bankers in our community that do this really well. And last year's Humdo analysis showed, actually 2 years ago, that a couple of our banks who have actually focused on employing people who are connected to the community, they reflect the diversity of the community that they serve, increase their presence in this market and serving traditionally underserved markets. So your non-white borrowers and your low to moderate income borrowers, they have made significant progress. And it's because they have focused on building a team of people. Because at the end of the day, this is when you get to a Rocket Mortgage sort of thing. If you apply online, you maybe will talk to somebody. They're probably not from here and they don't know you and they don't know that. So that goes a long way, particularly when we talk about the gap in the communities we're really trying to serve. But they're also reaching a lot more people. And so there's a really valid point. So we just have to kind of keep our eye on both, I think.
I think that's a really critical and point to bring up, Christy, that it's 1, 2, 3, 4, the fifth bullet point there, employ community savvy loan officers who are bilingual and culturally competent to reflect the diversity of the community around their branches. I know you just said that, but I thought it was important to reiterate it.
Yeah, and they also, the loan officers that work with borrowers, it might take longer. They're not going to close this loan in 45 or 60 days or whatever, but they're willing to do what it takes. We know home buyer counselors that have done that for many years. Those are real success stories. And so for consideration, I'm actually going to add some bullet points to this slide before we send them out related to cash buyers, looking beyond CRA regulated banks. The green energy, I think, is also a great opportunity because that's another source to help address some of the issues we have with our older housing stock, which also creates some of these loan to value and issues of like houses that might need more assistance, rehab, down investment in them that maybe you can't quite make up with the private loan, right? But they also, so here's some things we thought of, as well as the Fannie Mae's recent announcement around rental history, which is really actually exciting. It seems like a micro change, but really could help increase access to credit. A tight real estate inventory, though, is pricing out borrowers, and we talked a lot about that already. And then Lamont, I don't know if you, I just realized I just started talking, but you were going to do the slide, so I'm sorry.
No problem at all. I think we covered some of the stuff. Bethany was gonna maybe elaborate on Fannie Mae's announcement. Would you like to do that, Bethany?
Sure. So this is part of a bigger movement to get the Fannie Mae and Freddie Mac to actually use alternative credit models. I spoke about Vantage Score a little bit ago. And Fannie Mae just recently, I think on the 18th of September, announced that they would use rental credit or rental payment history to increase access to credit. That's one of the biggest factors in that alternative scoring model, but it's not the only one. And for whatever reason, Freddie has not yet announced that they are going to accept that. But my understanding is that they're working on it. We reached out to them and they said they didn't have anything like that yet, and they weren't ready to announce anything specific, but that was in the works.
Yeah, that's a game changer. I mean, people's housing payment is like the one thing that they make sure they do, if you know what I mean. So if that goes on someone's credit history, that is a huge win, I think. And you'll see, I think, in a few years how that might impact people's credit history, which we know is one of our top reasons for denial, right?
Yeah, if you want to learn more about that, Talis Shelbourne, who writes for the Milwaukee Journal Sentinel, did I thought a really good article on the issue, and yeah, so go ahead, and we lifted up Take Root Milwaukee in that article as well. Right, and Irma actually made a really good comment about lenders that employ people really reflect and how that even that practices change over time, but it really has an impact in this work that we do. And Jessica chimed in too about the rent; it must be paid via a bank account. So, and yes, thank you, Irma, but this formalizes it. So, and I think what the other thing is it really gets people thinking about things like Vantage Score and other ways, and the way we've traditionally thought about credit. And in the way that I'm sorry, I didn't mean to interrupt. That's okay. The way that ties back into Vantage Score is that until about a year ago, I can't remember exactly, but approximately a year or so ago, Fannie and Freddie and the other government sponsored enterprises, the GSEs, were precluded by law from using any other credit rating company besides the big one.
FICO?
What's that?
Is it FICO?
Yeah, FICO. Thank you. And brain brain issue. Yeah, that FICO was the only one that they were allowed to use. And so finally that Vantage Score, working with others in home ownership promotion, were able to show that their scoring for car purchases and other kinds of loans has been very predictive, and they use that alternative measure explicitly. So the law did get changed. There was legislation and it passed, and now slowly, things are changing with Fannie and Freddie, hopefully as well, in more than just officially recognizing rental history through the automated underwriting process.
Yeah, well, I do want to say too, I remember UEDA writing a letter on that issue a couple of years ago, I think it was. And we are a little after 11. So I think we're going to close that out. And we've talked a little bit about some of these issues, and this is also sort of things for us to think about for future webinars. So if you do have something that really particularly interested you, we've had some good suggestions. You can again drop them in the chat or reach out to me or Bethany or Lamont, so we can make sure to incorporate that in our planning, because we do plan to continue this series. So next steps are, yes, we will share links to the recording and slides. So everybody who registered will get that. And then we'll also share it in our Take Root update for members. Our next webinar will be Friday, December 3rd from 9:30 to 11. And we'll do the annual review of the 2020 HMDA data. And if you are interested in getting access to these reports for your own work, Bethany can do that for you. And so we really want to make sure we highlight that. And you've seen some of the filters here today, but know that there are a lot more ways you can filter the data. So
yeah, just to put a bug in your ear, or whatever the saying is, just to be, as an example, we could be as specific as looking at how many home improvement loans were made to any given population. So let's just say African-American women with high incomes within any specific geography. If that's something that you're interested in, tell me who you want to see, what kind of loans, what the geography is. And it doesn't take much for me to click the filters and push send, and boom, there's the report. So please do reach out if that's of interest to you, and we never charge for those reports.
well, thank you. And Lamont, did you want to say anything else before we end the webinar?
Yeah, I just want to thank everyone for spending time with us on a Friday. Go out there, have a good day.
Well, thank you.